Welcome to Smart Forex Academy. I am your coach Eric. In today's video we are going to talk about candlestick pattern. Candlestick. Introduction. There are many ways to read a chart. You can use Japanese candlestick patterns, Renko, bar, line, Heiken Ashi, point and figure, and etc. You're probably wondering, which one should I use? Well, if you ask me, the most popular approach is candlestick patterns. Why? Because it's easy to learn, and it works. That's why I've created this guide to teach you everything you need to know about candlestick patterns, and how to trade it like a pro. Here's what you'll learn. What is a candlestick pattern and how to read it correctly? Bullish reversal candlestick patterns. How to find high probability bullish reversal setups. Bearish reversal candlestick patterns. How to find high probability bearish reversal setups. Indecision candlestick patterns. Trend continuation candlestick patterns. Candlestick patterns originated in Japan during the 18th century, pioneered by rice trader Munehisa Homa in the city of Sakata. His methods for visualizing price movements became the foundation of modern technical analysis used globally in forex, stocks, and commodities trading. Now, it's likely the original ideas have been modified, which now results in the candlestick patterns you use today. Anyway, that's the brief history behind Japanese candlestick patterns. So, how do you read a Japanese candlestick chart? Now, every candlestick pattern has 4 data points. Open, the opening price. High, the highest price over a fixed time period. Low, the lowest price over a fixed time period. Close, the closing price. Here's what I mean. Remember, for a bullish candle, the open is always below the close. For a bearish candle, the open is always above the close. Bullish reversal candlestick patterns. Bullish reversal candlestick patterns signify that buyers are momentarily in control. However, it doesn't mean you should go long immediately when you spot such a pattern, because it doesn't offer you an edge in the markets. Instead, you want to combine candlestick patterns with other tools so you can find a high probability trading setup. More on that later. For now, these are 5 bullish reversal candlestick patterns you should know. Hammer. Bullish engulfing pattern. Piercing pattern. Tweezer bottom. Morning star. Let me explain. Hammer. A hammer is a one candle bullish reversal pattern that forms after a decline in price. Here's how to recognize it. Little to no upper shadow. The price closes at the top 1/4 of the range. The lower shadow is about 2 or 3 times the length of the body. And this is what a hammer means. When the market opens, the sellers took control and pushed price lower. At the selling climax, huge buying pressure stepped in and pushed price higher. The buying pressure is so strong that it closed above the opening price. In short, a hammer is a bullish reversal candlestick pattern that shows rejection of lower prices. Now, just because you see a hammer doesn't mean the trend will reverse immediately. You'll need more confirmation to increase the odds of the trade working out. Moving on. Bullish engulfing pattern. A bullish engulfing pattern is a 2-candle bullish reversal candlestick pattern that forms after a decline in price. Here's how to recognize it. The first candle has a bearish close. The body of the second candle completely covers the body of first candle. Without taking into consideration the shadow, the second candle closes bullish. And this is what a bullish engulfing pattern means. On the first candle, the sellers are in control as they closed lower for the period. On the second candle, strong buying pressure stepped in and closed above the previous candle's high, which tells you the buyers have won the battle for now. In essence, a bullish engulfing pattern tells you the buyers have overwhelmed the sellers and are now in control. And lastly, a hammer is usually a bullish engulfing pattern on the lower timeframe because of the way candlesticks are formed on multiple timeframes. Next, piercing pattern. A piercing pattern is a 2-candle reversal candlestick pattern that forms after a decline in price. Unlike the bullish engulfing pattern, which closes above the previous open, the piercing pattern closes within the body of the previous candle. Thus, in terms of strength, the piercing pattern isn't as strong as the bullish engulfing pattern. Here's how to recognize it. The first candle has a bearish close. The body of the second candle closes beyond the halfway mark of the first candle. the second candle closes bullish. And this is what a piercing pattern means. On the first candle, the sellers are in control as they closed lower for the period. On the second candle, buying pressure stepped in and it closed bullishly, more than 50% of the previous body, which tells you there are buying pressure around. Next, tweezer bottom. Tweezer bottom is a two-candlestick reversal candlestick pattern that occurs after a decline in price. Here's how to recognize it. The first candle shows rejection of lower prices. The second candle retests the low of the previous candle and closes higher. And this is what a tweezer bottom means. On the first candle, the sellers pushed price lower and were met with some buying pressure. On the second candle, the sellers again tried to push price lower but failed, and was finally overwhelmed by strong buying pressure. In short, a tweezer bottom tells you the market has difficulty trading lower, after 2 attempts, and it's likely to head higher. Morning star. A morning star is a 3-candle, bullish reversal candlestick pattern that forms after a decline in price. Here's how to recognize it. The first candle has a bearish close. The second candle has a small range. The third candle closes aggressively higher, more than 50% of the first candle, and this is what a morning star means. On the first candle, the sellers are in control as the price closes lower. On the second candle, there is indecision in the markets as both the selling and buying pressure are in equilibrium. That's why the range of the candle is small. On the third candle, the buyers won the battle and the price closes higher. In short, a morning star tells you the sellers are exhausted and the buyers are momentarily in control. Great! How to find high probability bullish reversal setups. You've learned the different bullish reversal candlestick patterns. Now, let's take it a step further and learn how to identify high-probability trading setups with it. Recall, you don't want to trade any candlestick patterns in isolation because it doesn't offer an edge in the markets. So here's how you do it. If the market is trending higher, then wait for a pullback towards support. If the price pullback towards support, then wait for a bullish reversal candlestick pattern. If there's a bullish reversal candlestick pattern, then make sure the size of it is larger than the earlier candles, signaling strong rejection. Tweezer top. A tweezer top is a 2-candle reversal candlestick pattern that occurs after an advance in price. Here's how to recognize it. The first candle shows rejection of higher prices. The second candle retests the high of the previous candle and closes lower. And this is what a tweezer top means. On the first candle, the buyers pushed the price higher and were met with some selling pressure. On the second candle, the buyers again tried to push the price higher but failed, and was finally overwhelmed by strong selling pressure. In short, a tweezer top tells you the market has difficulty trading higher, after 2 attempts, and it's likely to head lower. Evening star. An evening star is a 3-candle bearish reversal candlestick pattern that forms after an advance in price. Here's how to recognize it. The first candle has a bullish close. The second candle has a small range. The third candle closes aggressively lower, more than 50% of the first candle, and this is what an evening star means. On the first candle, it shows the buyers are in control as the price closes higher. On the second candle, there is indecision in the markets as both the selling and buying pressure are in equilibrium. That's why the range of the candle is small. On the third candle, the sellers won the battle and the price closes lower. In short, an evening star tells you the buyers are exhausted and the sellers are momentarily in control. Let's move on. How to find high probability bearish reversal setups. You've just learned the different bearish reversal candlestick patterns. Now, let's take it a step further and learn how to identify high probability trading setups with it. Here's how you do it. If the market is trending lower, then wait for a pullback towards resistance. If the price pullback towards resistance, then wait for a bearish reversal candlestick pattern. If there's a bearish reversal candlestick pattern, then make sure the size of it is larger than the earlier candles, signaling strong rejection. If there's a strong price rejection, then go short on the next candle's open. And vice versa for long setups. Indecision candlestick patterns. Indecision candlestick patterns signify that both buying and selling pressures are in equilibrium. And these are 2 indecision candlestick patterns that you should Should know, spinning top. Doji. Let me explain. Spinning top. A spinning top is an indecision candlestick pattern where both the buying and selling pressures are fighting for control. Here's how to recognize it. The candle has long upper and lower shadow. The candle has a small body. And here's what a spinning top means. When the market opens, both the buyers and sellers aggressively tried to gain control, which results in upper and lower shadows. At the end of the session, neither have gained the upper hand, which results in a small body. In short, a spinning top shows significant volatility in the market but with no clear winner. And yes, it looks like the toy you played when you were young. Moving on. Doji. A doji represents indecision in the markets as both buying and selling pressure are in equilibrium. Here's how to recognize it. The candles open and close are around the middle of the range. The upper and lower shadows are short and about the same length. Although doji is an indecision candlestick pattern, there are variations with different significance. They are Dragonfly Doji, Gravestone Doji. I'll explain. Dragonfly Doji. Unlike a regular doji which opens and closes near the middle of the range, the Dragonfly Doji opens and closes near the highs of the range with long lower shadow. This tells you there is a rejection of lower prices as buying pressure stepped in and pushed the market higher towards the opening price. 23. Gravestone Doji. Unlike a regular doji which opens and closes near the middle of the range, the Gravestone Doji opens and closes near the lows of the range with long upper shadow. This tells you there is a rejection of higher prices as selling pressure stepped in and pushed the market lower towards the opening price. We have come to the end of our tutorial today, and don't forget to smash the subscription button in order to be ahead when I publish a new video. Shalom.